What's up everyone, it's Kadi with Money Investing. In this video we are going to be talking about another software company that is one of my favorites. I've never really actually owned that stock because of the valuation, but they are going to be reporting their third quarter fiscal year 2023 earnings today after the markets close. So I'm going to be doing a video going over the expectations. We'll talk a little bit about their balance sheet, the cash flows, the valuation of course, and calculate their intrinsic value and where I would personally be a buyer of this stock. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining us. Of course, getting access to all the buy and sell alerts, options alerts, trade ideas. Like I said in my other video, we do have limited spots and the 16% annual discount does expire at the end of this month. So link's going to be down below if you want to join. Of course, be a part of our money investing community. So this right here is going to be the company, and the company is going to be Intuit. And Intuit is in my opinion, one of the best software companies out there. And the reason for that is because it actually owns a lot of different applications, such as TurboTax, Credit Karma, MailChimp, and even Mint, I think is owned by Intuit. And the stock obviously has performed really well. It has consistently moved up, making higher highs and higher lows. Of course, more recently though, it's had a very significant sell-off from highs of well over $700 per share, dropped about 50%. But of course, most stocks did during the 2022 bear market. But if you take a look at the entire performance of this company, it has obviously gone up and done very, very well from lows of well over $40, $50, or even $20 from back during the Great Recession lows. It's gone up over 3,500%. And right now, of course, we are just consolidating sideways, and they are going to be reporting earnings here in the next few hours after the markets close. So this right here is going to be those earnings expectations. So scheduled to announce the Q3 earnings results on Tuesday, May 23rd after markets close. And the EPS is going to be $8.49. That's going to be an 11% growth on a year-over-year basis. And the consensus revenue estimate is this is going to be over $6 billion with a growth of about 8.2% on a year-over-year basis. So like I said, they do also have QuickBooks, which is an accounting software. So they do already own a lot of applications that, of course, millions of people, millions of businesses actually use on a regular basis. And this right here was their financial highlight for the second quarter 2023. Revenue was up about 14% to $3 billion. And it grew online ecosystem revenue 24% to $1.4 billion, increased consumer group revenue $560 million, up 26% year over year, and reported Credit Karma revenue of about $375 million, down 16%. And the main reason for this decline in Credit Karma primarily was because of the decrease in home loans, personal loans, and just credit activity in general because of the higher interest rates. And grew pro tax revenue 7%, $253 million. This right here was their forward-looking guidance. So right now, as it stands, this is what they are guiding for the remainder of 2023, for the full fiscal year of 2023. And revenue is going to be somewhere between 14 and 14.25 billion. They're expecting a growth of 10 to 12%. GAAP operating income of just under 2.8 to 2.9 billion, growing approximately 9 to 13%. And non-GAAP operating income to as much as 5.2 to 5.3 billion, growing approximately 17 to 19%. And non-GAAP diluted earnings per share of somewhere between 13.59 to 13.89. That's going to be a growth of 15 to 17%. So that's a pretty decent growth. I mean, I would consider this to be a growth stock if they're able to maintain a 15 to 17%, even as much as 20% growth. That's going to be a growth stock in my book. If you come down to where the price is, 454, and if you consider that earnings per share number at around 13.80, let's just take that mid guidance, we're looking at a little bit over 32, 33 times earnings. We'll talk about the valuation in a little bit, but that's a pretty high valuation to begin with. And they are also expecting growth in the small business self-employed growth here, 19 to 20%, consumer group growth of 9 to 10%, and pro tax group of growth of about 3%. Credit Karma, again, they're expecting a little bit of a decline of about 10 to 15% because of the higher interest rates. Obviously, that's going to be what's hurting the business at the moment. Now, for a software company, the balance sheet is not great for Intuit. That's probably one of the two setbacks with Intuit, and that's kind of restrained me personally from investing in these companies because the company does have a lot of debt. I mean, it does have over $6 billion worth of debt, and goodwill makes up almost 50%, actually more than 50% of their overall assets. So you can see that cash, they only have 1.5 billion, investments 525 million, and long-term investments only about 108 million. So when you combine those three numbers, we're only sitting at over $2 billion worth of cash and investments. Goodwill is over 13.7 billion, which makes up more than 50% of their total assets of $27.2 billion. So if you take that out, we're only sitting at about what, $13.5 billion, and their total liabilities are about $11.3 billion. So yes, they do have more assets than liabilities, and even after accounting for goodwill, they have more assets than liabilities, but it's just that they have not enough cash to meet up with their long-term debt, which is sitting at $6.5 billion, and short-term debt $501 billion. So $501 million. So combined, that's a little bit over $7 billion worth of debt, short-term and long-term, and they're sitting on about $2 billion worth of cash. So definitely not a negative net debt, and current ratio is pretty decent, but when you account for a quick ratio, that's not so great either. So it's a little bit less than 1. So balance sheet's been a bit of an issue for Intuit, in my opinion. Now, when it comes to the overall numbers, very, very consistent company, right? So revenue growth has been growing from about $4 billion to over $12.7 billion. Consistent growth here. Gross profit also going from $3.4 billion to over $10.4 billion. And operating income also going from $1.2 billion to over $2.6 billion. So more than doubled in the last 9 years, which is a little bit slow pace, but it is at least consistent, very nicely growing every single year. Net income also on a very similar trajectory, although more recently it has more or less stabilized a little bit at just over $2 billion as of last year and the year before that. And shares outstanding have come down by about 1%, almost 1% every single year. And EBITDA and diluted earnings per share, everything has been on a consistent growth to the upside. When it comes to margins, the company's got phenomenal return on common equity, return on capital and assets are decent at just over 7%. And we do have gross profit margins over 80%. So for a software company, you expect these types of margins, and EBITDA margin sitting at 24%, net income margin at over 14% for the company. Now, they do spend a lot of money on operating expenses, right? That's why you've got a gross margin of 80% and a net income margin of 14%, right? I mean, this number should really be north of 20%, but the fact that it's lower just tells me that they are definitely spending a lot of money on operating expenses. It's your selling, general administrative expenses, R&D, all those types of expenses kind of eating into some of the profitability for the business. Now, this is where things get interesting, right? Valuation is the second piece that concerns me a little bit at 34 to 35 times earnings. It's definitely a little bit on the high side. On a GAAP basis, it's even higher. Enterprise value to EBITDA, we're trading at over 38 times on a trailing, 23 times on a forward. And of course, we got price to sales trading at well over 8 to 9 times sales, and price to cash flow at 28 to 29. So those are numbers that are a little bit on the higher side for valuation for Intuit. And this right here is going to be that earnings expectation from $13.82 to over $27 by the year 2027. If you plug in those numbers into our spreadsheet, we've got a growth rate of just under 19%. So this right here is going to be that growth rate of a little bit over 18.8% for the next 4 years, 4 to 5 years. And this is going to be that share dilution. So they have been buying back shares every single year by about 0.7% or close to 1% every single year. So if we take into account not an 18.8 or 19% growth rate, if we go a little bit more conservative, let's just go with 16% growth for the company's earnings, which in my opinion, it's still considered to be a little bit of a growth stock. And then let's just go with 20 times P multiple, and we do like a 12% discount rate, 10% margin of safety. You know, my intrinsic value, my fair value is going to sit at roughly around $312 per share. And right now it's trading at $454, which means, you know, 30% potential downside here needed. Net liquidation value, nothing really, because the company doesn't have a negative net debt, so it's got more debt than cash on the balance sheet and assets. So I mean, you know, that it's got literally negative numbers here, so we can just ignore that. But this right here is going to be that fair value for me, intrinsic value sitting roughly at $312 based off of a 16% growth rate and a 20 times P multiple, which in my opinion I think is more than reasonable, more than justified for Intuit at the moment. And the lowest it's got down to is 337. So we have indeed traded at those levels for Intuit. So if you come over to this stock here, you'll notice that we have traded down to that level as low as $337, $338 per share, $349 to be precise. I think this was also my fair value last time I calculated it. I might have to go back and double check, but this right here, very nice double support, double bottom really for Intuit, and that's the level that I'm going to be paying attention to. I obviously do have some flexibility, so plus minus 5%, so that puts us at somewhere between 297 and 328. But of course, this right here, I wouldn't mind kind of starting a very, very small position, getting a little skin in the game. But of course, a couple things that I want to mention is the balance sheet. That's always going to be an issue right now, at least in the medium term. And then the valuation. Valuation will improve as the stock price comes down, but balance sheet is something that we need to obviously pay attention to as well. So 349, 350 is going to be that technical support. Resistance right now is going to stay put at 488, close to $500. We have gotten rejected at that level a couple of times, and my fair value is going to stay put at 312 for this company. I like Intuit. I like their products. I like their services. I've actually used Mint or TurboTax and some of the other applications as well. But like I said, balance sheet and valuation's always been a bit of a concerning piece. Let me know your thoughts down in the comment section below. What do you think about this company, and are you actually buying or holding on to this stock? Are you planning to sell? What are your thoughts? Let me know in the comment section down below. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you want that 16% annual discount, access to all the private live streams and alerts. Again, link's going to be down below. As always, happy investing, and I will see you all in the next video.